Good afternoon to everyone who has already joined us. My name is Philip Bahoshi, and thank you very much for joining for a very special webinar hosted by MAGNiTT and sponsored by MERAK Capital, one of the leaders in private equity in Saudi Arabia, where today I'm very pleased to share some of the insights on MAGNiTT's first ever MENA private equity report. And then actually, more importantly, have a meaningful discussion with both the founder and managing partner of MERAK Capital to try and demystify and decode some of the takeaways of the report and what's happening in private equity here in the region. The way that we'll structure this is that I'll spend no more than 5 or 10 minutes quickly running through some of the slides from the report itself, have a fireside conversation with the two gentlemen, and then open it up for questions. So if you have any questions, please put them in the chat box, please put them in the Q&A box. We'll be sure to try and get to them at the end of the presentation. But as ever, we would like to take the opportunity to share some of the insights. Someone from the team will share a link to the actual report itself. And this marks MAGNiTT's next step of its evolution, where we started by filling the data gap in the venture capital space. We now want to tackle the private equity space as we continue to move into the wider private capital across emerging venture markets. I guess the first question to kind of answer is, what is private capital? Well, effectively, it's anything that's taking place in the private domain that is not part of the public markets, those that are stock exchanges and investments. MAGNiTT has historically been born out of the segment of venture capital, which is many of the webinars that we've done historically. This will be the first approach into the private equity, and you can actually access all of the data and intelligence that is part of this report on the platform itself. And we currently already cover venture debt while we look to explore private credit. Other areas of private capital include real estate, infrastructure, and natural resources, other areas that we'll look at in years to come. But specifically, when we look at private equity, I think that the nuance of private equity is that these tend to be majority investments into more established companies, as opposed to the venture capital space, which has historically been kind of growth capital or early stage capital to see exponential growth. The typical investments that you will see in the report and in any global private equity report are either buyouts, which are full-on acquisitions of entities, leverage buyouts using credit, private equity growth, which is actually a minority investment by a private equity entity, and then add-ons, where a private equity firm or a purchaser can buy another company and merge them within their portfolio itself. We, in the report, and I won't go into too much detail here, tried to take the opportunity to educate the difference between private equity investments and venture capital. I think one thing that's important to note that traditional private equity is still an LP-GP structure in exactly the same way as venture capital entities. This can be done off balance sheet, and sometimes sovereign wealth funds do participate on this. But the most important part is that there is actually an aim for that to be sold. There is an exit. Exits tend to take longer in venture capital because you start much earlier in the investment cycle. But in the private equity space, you still expect an exit of that investment. So in this report and as part of our methodology, we do not include mergers and acquisitions as part of those. But the IRRs are also different. Obviously, in venture capital, you're so much earlier in the investment landscape that your expected returns for those dreaming unicorns are much higher. But the IRR return in private equity is, given the shorter time frame, something that is slightly lower in terms of expectations. And so what did the report basically highlight? I mean, ultimately, the global private equity landscape, and this is data from international platform, saw a peak of private equity investment activity back in 2021. Similar to in venture capital, as interest rates began to increase off the liquidity boom that was seen in 2021 to curtail inflation, you saw declining private equity transactions and value of private equity. Now, one thing to note in this report, and one of the questions that I'll come on to ask, is actually, unlike in venture capital, where there is a little bit more visibility in terms of the value of transactions, they're often undisclosed in the private equity space, and this is a challenge that we want to try and continue to address. But in the US, there was a pickup both in the total number of transactions and the value of private equity transactions in 2024. Based on the report that we published yesterday or this week, sorry, we saw that the peak of investment activity in private equity was in 2022. A similar trend to what we see in venture capital, that there tends to be a lag in the investment activity here in the region. But similar to what was happening globally, we then saw 2 years of declining transactional activity in private equity heading into 2024. One of the predictions, which was published in the Bloomberg article that was published yesterday, is that we expect 2025 to see an uptake in private equity activity across the whole of the region. Interesting to note that where are these transactions taking place? Well, the majority in the region tend to be private equity growth. Those are the investments that I mentioned that were minority stakes in entities as opposed to majority stakes. In fact, buyout acquisitions have dropped from 57% in the peak of 2021 down to 29%. We anticipate that this is likely to continue to grow in years to come, the buyout activity. It's also interesting to note that leverage buyouts are a very small proportion of this investment activity, especially when interest rates are high, and that's not necessarily been the traditional case here in the region. When we looked at this for the US market, it's actually interesting to note that 60 to 70% of all activity are add-ons, and actually that both growth capital and buyouts play a much smaller percentage. In terms of the actual capital that's being deployed, you see where is this taking place? 63% of all transactions here on the left-hand side are deals of around 0 to 50 million, and 50 to 100 million are around 13%. If you take the US equivalent report, you actually see that 60% of all PE transactions are between 100 and 500 million dollars of transaction value. So the actual size of private equity transactions here in the region are much smaller than what we've seen in the US. And when we look at some of the geographical split, very interesting to note that close to 68%, and this is a 5-year aggregate figure, of all private equity transactions that were recorded have taken place between the UAE and Saudi Arabia. Very GCC dominant, very large economy dominant in terms of that type of behavior. And even between the two different geographies, you've seen fluctuations and changes of the total number of transactions. Finally, just to look at some of the sectors, well, unlike in venture where you see e-commerce, logistics, fintech, other areas, in the private equity space, and again, this is an aggregate 5-year view, 64 transactions, 18% have been in healthcare, 17% in financial services, and 11% in the food and beverage space. So very different sectors to what we've seen more traditionally in the venture capital space of what's interesting for a private equity investor here in the region. So for anyone that's interested, you can get full access to every transaction and investor through the directories. And we'll be sharing, again, as part of the conversation, the report, which you're welcome to download and get access to for all of the latest data. And we'll be continuing to be published regular reports by country, by region. And again, this is not just the MENA data. We have data on Africa and Southeast Asia as well. And with that, I would like to move on to actually having a conversation with the gentlemen that have joined. I'll ask them to open their cameras and unmute themselves. Just by way of introduction, it is a great pleasure to have both of these gentlemen. Not only are they trailblazers in terms of private equity in Saudi Arabia, they have been very active in the venture capital space, and I am honored to be able to also call them my friends, as they have been very keen partners to myself and MAGNiTT in the kingdom and beyond that. So without further ado, I really welcome both Abdullah Al-Tamami, founder and CEO, and Othman Al-Khair, managing partner of MERAK Capital, to this webinar. Thank you very much, gentlemen, for joining us today.
Thank you.
Thank you, Philip.
Thank you, Philip.
Pleasure to be with you.
Indeed.
Gents, let's jump straight into it. Oh, sorry.
Please.
Thank you. But let's jump straight into it. Look, I mean, I was on Bloomberg this morning talking about the private equity space. I was at Investopia yesterday, where the Minister of Investment of the UAE is talking about the private capital space as being the growth opportunity for the region. In super returns, when we were there together in the Riyadh, there was a lot of excitement about private capital and the opportunities that exist. To let the audience know a little bit more, why do you think that people are now waking up to the opportunities that exist in private capital across the MENA markets and the wider emerging venture market space? I don't know, Abdullah, would you like to kick us off with your thoughts on that?
Sure. Okay, I think it's multifaceted, or for multiple reasons, to keep it simply. Um, let's start with the most basic ones, and then maybe go to the more complex ones. So the most basic ones is, naturally you have, in the region and mainly in the kingdom and neighboring countries, an expansionary policy from the government, driven by the government, whereby investments in multiple core sectors to the economy are being deployed and activated by the government and its semi-government entities. And as a result, that is encouraging private investors, institutional and otherwise, to collaborate and tag along these major investments. And that has caused a lot of activity, which has resulted into positive results to these private investors, be it through public offerings or trade sales of these assets, but mainly the most substantial returns, which are, naturally speaking, is the case from an historical point of view for private capital in general, are those returns that go from taking your private asset to the public markets, be it an equity asset, be it a private, even a credit asset, where you securitize it or otherwise. So that's the natural answer. And then there are more complex reasons that are not only reflective in the region, but also reflective globally. You see, there is a major trend from a business point of view for managers. That is happening heavily across the globe, which is a big drive towards private capital. And that is mainly being caused by the concentration of returns for managers in private capital, as opposed to public capital or public assets. As a matter of fact, there is a good study, I believe it was the full year study by Bain for private equity in 2023. I believe it was full year report, and they issue it every year, and it's every year. It's really good. It's really insightful. I advise everyone to look at it. What they looked at, and there's another one by BCG as well, which is really good. But what they looked at is from the total assets under management globally, you're looking about globally in all assets, you're looking about 20-30% are concentrated into what is called alternative assets, which are alternative or majority private capital, not all, but majority. And then within those 20-30% of alternatives, they represent between 60 to 70 of all asset management revenues globally. So it's quite disproportionate. And you see premium returns in private capital or alternative assets are being rewarded much more handsomely from a manager point of view than public equities. Now, there are many reasons, be it one of them is the proliferation of computing and AI into public equities and public assets, as well as the ease of access for managers into that market, creating a suppression of economics for managers. So these are the two, one, I would say, obvious reason, which is micro more to the region, and one macro reason that is driving this return and this activity into the private capital business. I would love to hear what Uthman also.
Yeah, I want to double click just on that, but Uthman, specifically,
Sure.
like when you're speaking with your friends and people in the industry, I mean, if I remember my days at Barclays, people were always very traditional. It would be fixed deposits, it's real estate. That was the historical mindset of investment. Are you now seeing kind of a growing appetite for private capital as an asset class amongst people that are looking for, effectively what Abdullah is saying is alternative returns, that diversification of your portfolio of investments into other asset classes?
I think many want access to alternatives. The question is what is available and how can you access it. But either individual investors or retail investors, or DPM investments, or family offices, across all investors. Everyone wants to take position in alternatives, but the issue is the accessibility of these asset classes. And I think one of the things that I've seen in the last few years, you're seeing, some of these sectors are emerging and becoming more accessible. You're seeing more accessible private equity opportunity. You're seeing more accessible opportunity in venture capital and private credit, sukuk as well. And in my opinion, and from what I see and from my experience, I think the environment, generally speaking, and the markets, generally speaking, are improving. And previously, if you want to go with a manageable risk alternative investments, there are not many. I wouldn't say it's a lot now, but it's improving year over year. And one of the reasons is the change in the regulation, and you see a lot of changes in markets. So when you talk about the cybersecurity, for example, the market, you're seeing a lot more clarity than 3 years ago. When you talk about data management, there was a lot of regulations introduced in that space, as well as other sectors that we're not expert in. You see a lot of more clarity, how things will evolve, how they will get their licenses, and how would they grow and access new growth opportunities. And that encourage private investors to go for these markets. So I would say, to summarize it, the markets itself for these companies, and the accessibility from capital market point of view, where managers can take position. I will end with one final note. Big investors like sovereign, or big family offices, they're looking for big opportunities. But now, emerging fund managers, they see good opportunity in, investment opportunity within the 1 to 500 million riyal, which is good for their effort, while big investors, they don't see it as attractive. They rather stay on the debt side of things, or sukuk, or real estate, because their portfolio is bigger.
Hey, can I ask a question, maybe Abdullah? Like, you are angel investors. You started MERAK to a certain extent as a venture capital entity. You're one of the first to now transition not only into just pure private equity, but into debt. But specifically when we look at private equity, I guess the question is why? What is it that you see as an opportunity in private equity that you didn't necessarily see, or would like to complement what you see in venture capital? And so for someone that may be listening, what is it that's appealing about the private equity space?
Right. So one of the things we usually think about when we're looking at investments, especially in equities, to keep it simple, we always try to distill our mindset to first principle thinking. And when we do that, we quickly realize that, be it early stage, be it growth stage, or late stage, or IPO, even as a public company, at the end of the day, they are equities, and you're investing in businesses. And when you start from that point of view, and you try to hone in into the similarities between asset classes at different stages, you start to build a mindset and a framework on how to approach these opportunities. Now, this doesn't necessarily mean that they're similar. It just means that they have similarities, and they have fundamental differences. And then once you start with the similarities, you start building on the differences. And when you build on the differences and the challenges and opportunities thereof, you start to customize your market approach and go-to-market strategy to each asset class. So initially, when we even before Uthman and I founded MERAK Capital, we were quite active in the private market, be it in the late stage or the early stage investment in technology-driven businesses. And even from that approach, we always noted that you have to continue thinking about these businesses as businesses. Even if they were early stage, they were hyper growth, they have to always drift back to the mean, which is you are a business and you have to return money to shareholders. And it's more true in the region than elsewhere. In the region, there's a shorter patience to reach profitability, as opposed, let's say, in the US, the extreme of things. So that's one thing. So first, realizing that you're investing in equities. The second thing, you start to analyze, okay, what does it take? What does it take for your business when you invest in angel stage, let's say? What does it take for you to return your money 100 times, 1,000 times as a VC investor? If you look historically in the region, the most handsome returns and the most viable returns for your risk have been into companies that went public, although there are not many. But that has proven to be the predictable model, replicable model, and reliable model. Although it's difficult, but it is reliably result-oriented. And when you look at trade sales or M&A in the region, from a VC point of view, they have not, and this is a reality we have to accept, they have not yielded VC returns. Although the frequency of transactions is ultimately higher than IPOs, IPOs historically in the region have yielded VC returns, while exits through M&A have not. And then there is a research we did when we first founded the company. Although we wanted to publish it, but it was quite heavy for us to publish, and we always try to share it into. Yeah, sure, I'll be happy to. And the research has cross-referenced multiple things. First, how do VC returns happen from M&A? Okay, I'm going to take a minute to just explain it. So bear with me. How do returns happen from M&A? And this is region agnostic. So be it US, China, or Europe. Most of the frequency of returns happens from M&A, but most of the sizable returns happens from IPOs. And this has been the reality across the globe. And then you say, okay, so the frequency of M&A, although the frequency is about 90% of exits of VC-backed in the US are from M&A and 10% from IPOs, it's the flip side of absolute value. 90% is from IPOs from a dollar value and 10% from M&A. And the M&A, most of the M&A, above 70%, is actually $100 million and below, which is not meaningful for VC funds. And most VC funds are actually, in the US, on average, you're looking at $50 to $100 million, although there are mega funds, but that's the average size. And then when you connect the dots and you say, okay, so that's how it's looking. What about cross-continental M&A? Do US companies buy European companies? You'll be very surprised when you do the math and you do the homework, that is actually quite rare from a statistical point of view. And then when you build on that model, you start to quickly realize that relying on international companies to buy local companies is actually futile, unfortunately, from a business point of view. And then you say, okay, so I have to rely on regional companies to buy regional companies. And then you make that hypothesis and you try to prove it. And then you say, okay, what is the ID, or what is the profile of the acquirer of VC-backed companies? And then when you do the math, it's actually 70% of VC-backed acquisitions from public companies happened from previously VC-backed public companies. This means you have to fill the public market with VC-backed companies so that you can rely on them to create the ecosystem of purchasing other companies. And we saw that. We saw that in Jazz, buying multiple companies, even though they have been IPO or public for a fairly short time. And we expect to see more of that. So with that being said, it drives our thinking. And then we say, okay, what is the time from angel investment to IPO? And we have looked at it in the region, and it's actually fairly shorter than the US or Europe. You're looking at 6 years on average. And when you put that together, as an investment manager, like us in MERAK Capital, you quickly realize that for you to be an effective manager, you have to master all stages of private equity. And when we say private equity, we mean any private equity, and that encompasses early stage, VC, growth, etc. Although traditionally, as you said, and you explained just now, Philip, private equity is not really, it doesn't encompass VC, but on the fundamental sense, it does. And that's how we try to think about it. And then we try to customize our go-to strategy based on the stage. Sorry for taking a while, but I felt I had to explain that to explain our thinking.
I think that makes sense. The point, though, is that traditional PE is still, in most cases, an LPGP structure. And I'm assuming yourselves, there's an LPGP structure. So when you're speaking to LPs and positioning the private equity space compared to the venture capital space, what's the reaction and the appetite for the private equity type of solution as opposed to VC? I mean, we've been doing the SVC report, the MAGNiTT report for 10 years, SVC report for 5 years. People are familiar with that space. What's the appetite for the LPs of private equity as an asset class when you're speaking to them? Noting that, and it's kind of a two-part question, the sovereign wealth funds have been the biggest acquirers in the private equity space here in the region for the last couple of years, because they've effectively been one of the few people that are with clear mandates looking to purchase and then flip and acquire and do that transaction. So maybe I'll start with Uthman, and then on the question of the LP appetite, and maybe Abdullah on the view of the sovereign wealth funds.
I think the appetite, as I mentioned earlier, appetite is there. You just need to give the comfort of delivering on the promise. So generally or typically, as you mentioned in your report, there is a timeline, there is entry valuation or entry value for the company. So, putting together an offer for our LPs to come and invest in private equity is not difficult. It's actually easy. But delivering on the promise is the difficult part. And I think from our side, what we're betting on when we started the practice is what would contribute to the target IRR the most, that will deliver on the expectation by our LPs. And from our side, both Abdullah and I, we have founded companies before, so we understand the number one factor is growth. So we give high attention when we come and join or invest in these companies, that what value we will bring to these companies, and that growth that is coming by joining a good team and by providing our resources, our expertise, will deliver this IRR. So you define the entry point, you define the exit point, you put it all together with the LPs or investors in our funds, and we prove to them that we're capable of providing or putting a value creation plan that will deliver that promise. LPs, if they see a good plan, they're willing to take the risk, and this has been our experience in the last few years. So this is how I see it.
And the role of sovereigns, I mean, I keep hearing this criticism that like the biggest players are sovereign wealth funds in the private equity space. The question was asked to me this morning. I think that they're catalyzing the private equity space. They're both the funders and the acquirers, and in the end, they still have very clear mandates for return of investment, and that the private market, the private capital, will come into this space once they start seeing the returns that you've mentioned, the liquidity. How do you see, Abdullah, the sovereign wealth funds in the region, in the private equity space?
I think you definitely highlighted what is the case, and it touches also on what Athna mentioned earlier in terms of size and opportunity size that is meaningful for these sovereigns. You see, sovereigns in terms of activity and perceived mandate are not to be assumed to be similar to sovereigns in much more mature economies. Although they are both sovereign in that sense, when you compare to, for example, the Norwegian sovereign fund or much more mature funds as opposed to the GCC sovereign funds. The main difference is that GCC economies, mainly Saudi Arabia and the Emirates, are still fast growing economies, relatively speaking. And these sovereigns are acting as a catalyst and an initiator of opportunities, an enabler of certain industries to be part of the engine growing these economies and capitalizing on low-hanging opportunities. So it's purely from being an opportunistic funder. And that is definitely encouraging private investors to invest. Private investors have existed and have been, and this is, I think, a misconception for a long time in the region by managers, is that a lot of private investors in the region are not as sophisticated as investors elsewhere. And this is a big misconception. They are actually quite sophisticated, and they have been active for a very long time in the most advanced managers globally. But they want to see certain signals in the market to be active. One is what Athna mentioned, is that an opportunity that's attractive, a manager with a track record of building businesses, and an activity that is coming from a bigger player, like a sovereign fund or a government or semi-government entity. And they will activate their portfolio. And that's something we've been seeing quite across the board in different industries. So sovereigns are being opportunistic, which is good for economies. They have a higher return than what you usually see, target return, than what you usually see in other sovereigns globally. That's why they're looking at these private capital opportunities to drive that average return across the portfolio. And it's reflecting, because we're seeing it reflecting on their books, it's reflecting on the returns. And they're playing as a catalyst of sometimes incubating or launching new businesses that are quite successful and quite enabling to these industries that they're targeting. So they're a very active player, especially given their size. And from a private point of view, as managers, we see that as a very positive outcome or very positive dynamic in the market today.
It's also worth mentioning that we've never seen them compete with us in our deals. And I think sovereigns usually work on, bigger deals, while the opportunity for fund or managers like us is usually in the mid-size opportunities.
A little bit of a difficult one, but I got asked it yesterday, and I'm going to ask you. The region struggled post-Abraj on private equity, specifically here in the UAE, with the confidence of private equity, which became a hot potato that nobody really wanted to touch. Considerable amount of time has now passed since that scenario, but we haven't necessarily seen a drove of investments in the private equity space. Have you seen that impacting conversations that you are having, or do you think that the hangover effect of the Abraj crisis is maybe central to the UAE, not Saudi Arabia, or have we just moved on from that situation?
Okay. So I think, and this is important to highlight, I think what happened to Abraj or even another manager, if it was not Abraj or something, I think it's just a natural outcome to any growing ecosystem or industries. I mean, we all, I hope all, remember long-term capital management in the US in the 90s. It was a big implosion, and it was a big story. Still today, it's referenced and how it impacted the market at that time. But it's still maintained to be robust. If you look at different regions, you'll always find these stories that did not go as planned. And it's a natural outcome of any ecosystem. And we don't see that as a black spot or something we have to get over. We see it as a natural occurrence that happens in most industries that is going through hyper change and hyper growth, which is the case. So honestly, very rarely we saw mention of a branch or someone similar from an LP. As mentioned, remember what we mentioned earlier. Most LPs are quite sophisticated, so they kind of know when to look at a good opportunity or a bad opportunity, and a good manager or maybe a manager that still needs time to mature. So it's not something that is a bottleneck or a bump that the region has to get over. Honestly, it's just a natural occurrence of any fast-growing industry or fast-growing ecosystem or region. And at least to us, we never really think about Abraj or any other manager that did not realize their vision or they failed in achieving what they wanted.
Fair enough.
If you allow me just to, throw one thing here, is investors are aware that there is an investment risk and there is an operational risk, especially institutional investors. And one of the things that is quite common is for investors to ask for operational due diligence. It is a standard document that we prepare for our institutional investors. Once you provide something like that, they get over the risk or the fear of having another incident like this. But I agree with Abdullah. It sometimes happens for investment managers, or sometime in the other sectors where just the hyper growth makes these players face things that they did not calculate properly, and it becomes an event where everyone is talking about it, and sometimes it affects negatively for a while. But with the flow of other opportunities and other successful events, people just get over it.
Of course, I want to get to any questions, and I've seen a couple coming through, so please share them and I'll get to them in a couple of minutes. I mean, just focusing on the actual industry itself, specifically in the kingdom and the wider MENA region. I highlighted earlier that historically the sectors of interest in private equity have been healthcare, financial services, we said food and beverage. From the conversations that you're having, I know MERAK may be a little bit different, so I'd like to hear MERAK's view, but also what you see in the industry in terms of private equity. Where do you see in the next 2 to 3 years the biggest opportunity and hotspots for private equity investments in the MENA region? I don't know. No.
Yeah, I think this is quite interesting, and honestly, it changes by the month, I would say, because everything is growing so fast and opportunities are emerging everywhere. As you mentioned, in MERAK, we kind of focus on tech-enabled and tech-centric businesses. Although today, pretty much 80% of what's going on is tech-enabled somehow. So kind of our horizon and universe has increased in the last 3 years. So with that being said, the way we're looking at it, we're seeing growth across different segments. Honestly, it's quite obvious B2C is a big vertical across, be it F&B, be it financial tools and services, or even fast-moving goods. So that's one, and that has been happening in the last, I would say, 3 to 4 years. And we saw a few public companies or a few VC-backed companies or let's say private-backed companies go public. But I think what's happening also quite fast is B2B businesses. B2B businesses are maturing, are becoming really, really attractive, be it they are in the enterprise level, or be it in the government, or somewhere in between, and across the board, whether it's enterprise solutions or B2B enablement, etc., is rapidly growing. And I think what's happening there is that the local players have figured out how to create an edge over international vendors and international providers. And I think that there is an unwritten playbook that's being created on how to compete within the international vendors. And that is really creating a lot of potential value and opportunities for fund managers such as ourselves to tap into. And of course, we're seeing in the traditional market big opportunities, be it private equity based or private in general, be it real estate, healthcare, education. Education is huge. I mean, the demand for education and just basic as schooling in the kingdom has skyrocketed, and the demand has outstripped supply across ages. And for us, one of the biggest challenges is prioritizing opportunities. It's not really finding opportunities, because that's not really the hard part. And we should be all thankful and blessed to be in this time where there's hyper growth across different economies in the region. But that's the main challenge. And I would love, because this is something we always discuss, Uthman and I, and with the team. I would love to hear also Uthman's thoughts on this, because it's really interesting and keep changing topic.
I would say we get more excited about the things that we understand or we are very resourceful in. Sometimes we see great opportunities and we hesitate because we don't know what kind of contribution we will provide beside money. So makes us sometimes not quite sure how to proceed with that. However, there are a lot of opportunities around the B2B technology side that we are highly exposed to, where people do not get or do not understand. And the trigger for it, in our views, is the change in the ecosystem or the change in regulation. And I'll give a few examples. So one of our companies, we invested when the government introduced a new regulation in the data governance and data regulation. And when that happened, all of a sudden the demand for these services increased, and it drove a lot of growth to the company. Another opportunity that we invested in, simple SaaS model, but there was change in the market where the government have provided a lot of integration within that SaaS. So the value that they provide to their customer is heavier or higher, and it drove more growth. So there are changes that happen in the market or within the ecosystem that drives more growth, and we try to predict that. And it's easy to predict because the regulators, they communicate what they're planning to do, and you can navigate what are the tech opportunity within that sector. So we're bullish in tech. It's usually double-digit CAGR, not the traditional, hardware, ICT, but the software side and the emerging tech. There are a lot of exciting opportunities, and I think we are in a very good market and a very good years in the coming, 3 to 5 years.
Gents, honestly, I have 3 pages worth of questions, but in the interest of the audience participation, there's a whole bunch of questions that have come through. The only thing I ask, if we keep them brief, we'll try to get through answers brief so that we can try to get through as many as possible. Tell me which one of you wants to take any of these questions. I'll start with Mohammed Qadquda, who's a good friend of MAGNiTT and from MERAK Capital. He asks the question: a lack of acquisition financing for non-sovereign institutional investors is a hurdle limiting private equity buyout activity, which we said is about 30% of the activity. Do you think Saudi banks will offer acquisition financing more readily, or will government entities like SIDF spur activity in specific sectors that are tied to Vision 2030 through incentives and loans? So basically,
okay, good question. Just to be quick, no, is my answer to that, and my advice is that do not or avoid and refrain from taking models that work elsewhere, where you have buyouts being financed as a leverage buyout, and you need to customize your private equity activity to the local ecosystem and the local region. The local region doesn't have many sponsors, although the most common transactions globally are financed through leveraged buyout or otherwise, but locally it's not the case. So you have to be innovative in doing that, and you have to find ways to hit that return. And in our view, it should not be an excuse to not deliver on the private equity return. So that's my advice, and there are many opportunities that will allow you to execute on that return without needing financing. All the financing would be great, but you have to customize and localize your private equity solution.
We spent a lot of time talking. Sorry,
if you allow me to just jump on this, we see the government is more aggressive here than internationally because they're taking equity position in the local funds when it comes to their specific sector. So they rather take equity and play a bigger role in their specific funds. There is, industrial development fund. There is a tourism development funds. There are cultural development funds, and they're all playing a big role trying to push the ecosystem. So from an equity side, they're doing a lot of a bigger role than just a loan.
We spent a lot of time talking about the investor side of things. There's a question here from Faizan Sheikh. Can you comment on the appetite for established businesses to be acquired by a private equity acquirer? How do you evaluate the pipeline of deals that you can potentially execute on? And more interestingly, I was going to ask this question, but in the interest of time, I moved on. Traditionally, a lot of these businesses are family, multi-generational businesses who have always held the companies within the family. Have you seen that as a barrier, albeit probably in Europe and the US, it was the same thing, but culturally here, maybe it's going to take time to change. Have you seen that mindset as a barrier to potential private equity acquisition, as opposed to what you've been mentioning more as private equity growth capital for growth? So I guess the pipeline of opportunities and the appetite and the family business mindset of the potential companies.
So to keep it short, there is definitely more appetite for growth private equities or growth equity, where you buy minority stake or major minority and fuel the business. However, I think one aspect of private equity in general as a business that is not being emphasized enough by managers is the need for you to sell the idea and sell yourself as a manager, as an acquirer. Unfortunately, a lot of private equity professionals do not come with that mindset. They come from the mindset of more of a financial analytical point of view and try to convince from that end. But it's very important to connect with these families. We see the appetite increasing with more IPOs and more liquidity coming into the market. And we see that is opening up further and further. And we see more and more owners who want to sell the whole business or the majority thereof. But we do not see, and to be very frank, we do not see more managers being more on the convincing side, on the selling side, on the this is why you should consider my offer. And that is missing in the region, but it's an area that is increasing and being filled as we go further.
What is the current state of exit opportunities for private equity investments in the region? You touched upon this before, Abdullah. It's the important part of the equation. You've just mentioned that there needs to be a sale. We've talked about the IPOs. Where do you see, with all of the challenges that you mentioned in international acquirers, regional acquirers, where do you see the state of exit opportunities for private equity investments, not venture capital investments?
Public. You have to go public, and this is the way. Now you have NMO, which is a growth equity market. You have main market. You have UAE, multiple markets. You have to build your business to go public. You cannot build it for an M&A. Right now, we're not there yet because we already established that, generally speaking, M&A cross-continental is actually rare. And you have to rely on public companies acquiring you. That's the majority of transactions. So right now, we're not at the stage where public companies are many. So we are at the at the 20, 30-year market maturity cycle, we are at the stage where more companies going public. So you have to go with that trend if you want to make meaningful exits. If you look elsewhere, it will be very challenging.
I'm going to ask you a follow-on question, which has actually just come through, which I think is quite interesting. He said, hi guys, Syed is asking, given how the Talabat IPO, in which the owner sold the company to Delivery Hero, who in turn, after several years, listed it on the DFM, played out, do you think more upstart tech companies go through a bizarre exit route with the original owners selling to private equity, sovereign wealth fund, MNCs, which then go on to do IPOs later on?
I don't know. A quick answer: no. I think actually what happened will stir entrepreneurs to stick around and not sell, honestly, and push their companies to go public. What do you think, Athman, about that one?
I think judging from what we, our conversations with most of the companies that we talk to for investments, most of them, they want to stick around. They don't want to leave the company. They still see opportunity and they see big reward in the listing. And they're talking to us because they think we will add a lot of value in this partnership and in delivering an attractive valuation by doing the right thing in terms of growth, in terms of governance, in terms of finance, in terms of HR and hiring C-level, and making the company have some of the missing elements that usually the founder have built but did not complete. And they think a new partner will come and put together the puzzle to make it more attractive for the public market. So this is how I see it. I do remember a conversation with a founder where they want to sell 100% to us, then we will go and list. However, I think in this case specifically, Delivery Hero is in the, they are in this core business. So, it's normal for them to come and negotiate with the founder and buy it. Then they go for listing. So it's good for Delivery Hero.
Othman, if I may, we had a quick conversation offline. We talked about the real value in private equity is value creation that's provided by the entity that is giving the injection. What does that mean to you, and how is that different in a private equity transaction to a venture capital transaction? What is the value add or value creation that an entity like MERAK provides to an entity that it looks to invest in?
Very good question. I love this question, and I always maybe talk more than I should. So bear with me.
It's okay. We have 5 minutes, and I want one more question afterwards. So
no, generally, we're founders. We've accumulated some resources, some understanding, and this is how we go and make an impact for these companies, and we continue to add. So week over week, month over month, we increase our resources. We work with more advisors. We have stronger experience when it comes to governance, stronger experience when it comes to finance, stronger experience when it comes to hiring C-level, and stronger experience in terms of how to unlock new growth opportunity in a company that is already growing. We're not investing in companies that are declining. We continue to develop this value creation plan, and our style is, a senior executive will lead from our side, will lead the committee in a specific topic. An external advisor will play with this executive as a PMO, and an integrated multi-advisors will work with them. So I'll give you an example. If it's an IPO committee, someone will lead the IPO committee. An advisor will come and become his PMO or his guy managing different stakeholders. Under this advisor, there is, the financial due diligence, the legal due diligence, the market research, the financial advisor, or whatever is required in order to deliver on the mandate. On the digital transformation, it's the same thing. We do a committee It's led by a strong leader from our side. Under it, there is an advisor that is used to the different diagnosis and the different execution needed to make an upgrade that will impact the company, either on the delivery side or on the growth side. So we do these, different committee for every company that we this committee is not a MERAK committee; it's a company committee, and we contribute to it, and the company contributes from their side, and all shareholders they try to enhance based on the topic. So usually there is growth, there is digital transformation, there is financial transformation, there is IPO, and every company has its own requirement. So this is how we approach value creation, and we're a big believer that this is, in most conversation, this is more important than money when you talk in private equity. Unlike VC, cash is more important to founder.
Gentlemen, I can't thank you enough for the opportunity to share these thoughts with you. I am very excited and selfishly interested in the private equity space at MAGNiTT, but to be able to share that journey with yourselves and industry experts, I really do think we're on the cusp of seeing both regional, government, and international interest in this space. You guys were one of the first to get into it, so I highly commend you, and I very much look forward to seeing how this develops and exchanging thoughts, and I'm sure that we can touch base in a year's time and see how the ecosystem has evolved. But thank you very much for your contributions today, and I look forward to hearing all of the news that you have in the kingdom.
Awesome. Thank you so much.
Thank you, gents. Take care.
Take care.
Bye-bye.
Bye-bye.